Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Senior Portfolio Manager and Partner at LLC Private Wealth. Today we're going to be talking about 5 sources of income in retirement and how you can optimize them for after-tax purposes. Most people go through preparing for retirement, thinking about the saving side of things, getting ready, putting money away, and putting it to work for you through your investments. But not a lot of thought tends to go into the exit plan, how you're going to get that income out and in the most efficient way possible. And that's really a big component of a strong financial plan. Today we're going to be talking about 5 different sources. We're going to talk about your pensions, government pensions. We're going to talk about private pensions, whether you're self-employed or working for a corporation. We'll talk about registered funds, so your RRSPs and tax-free savings accounts. Investment accounts, and these are your taxable accounts, and of course real estate investing and how you can turn that into income. A big part of this is to make sure that you're diversified in the different flows of income when you are in retirement, because a lot of people hear the different stories in the media about RSPs not being a great investment tool because when you do go to take the money out, you've not diversified the different types of income that you're getting, and you end up paying a lot of taxes, often higher taxes, the discounts or the write-offs you got for putting the money into the RSP. So we're going to cover how you can avoid those types of pitfalls. So let's start with pensions. So the government pensions, there's basically 3 types here in Canada. CPP, your Canadian Pension Plan, that's the one you contribute through your paychecks from age 18 to 65. If you're working here in Canada, everyone qualifies for a different amount. You can start taking it as early as 60 or delay it past 65 and get higher amounts. There's not a lot of playing around with that other than some income splitting with spouses, but it needs to be taken into account in your overall income plan. The Old Age Security, or OAS, is the other one that most people qualify for. It's not based on earnings or working years, it's based on years you've lived in Canada from age 18 to 65. So if you qualify for that, this one really important to take into account with all your other income sources, because if your income goes over a certain amount, they will claw some of it back. So do take that into your big picture plan to make sure you're not losing some of your income unnecessarily. The GIS, or Guaranteed Income Supplement, is for lower income families in Canada that will top up your pensions, and that kicks in at 65 as well. Now, private pension plans, there's a lot of different types. So we'll touch on private corporate plans, so IPP and RCA. So these are for business owners or key employees of the business owners. They're great for retention, they're great for tax deferral, but in themselves, they deserve their own video. They deserve much more explanation. So I will say reach out to us, go to mikeonmoney.com if you're interested to learn about these. They're very powerful tools. They do need to be planned out to make sure you don't get into a tax trap there, but they can help you diversify a lot of income through your growth years of your company. Company pension plans, these are the ones the companies offer you as employees. There's 2 different types. Defined benefit plans, these are great. So the amount that you're going to get is based on your earnings, often the best 3 of your last 5 years that you're working there, and it depends on how many years you worked and your age at the time of retirement. So those ones, they're fully taxable as income, so that has to be built into your plan as well. The defined contribution plans, those are where the company allows you to put money into your pension and you can direct the investment. How much you get out, though, is really going to be determined by how well the investments perform. Corporate accounts are kind of another type of pension plan, or a lot of business owners will put money aside in their corporate accounts. They can be very tax efficient, almost as good as RSPs. But you do have to plan how that's going to come out in retirement. There's a lot of different strategies that can be employed, but you shouldn't ignore, again, you can do a great job of saving money in there, taking advantage of the taxes, but you really need that exit plan for the end. So let's move on to registered plans. So RSPs and tax-free savings account. Tax-free savings account, we'll start there. Super powerful new plan. Fairly limited as to how much you can put in there. The contribution amount moves with inflation. Last year was $6,000, next year is going to be $6,500 that you can put in, but your lifetime amount come 2023 should be close to $90,000 that you can put in there. So really powerful. Money goes in, no deductions, comes out all tax-free. So that one's a must-use. RSPs are also a really great plan for your especially your higher tax years. Get in that deduction room, but again, you don't want to fall into that tax trap. You really have to plan the exit and how it's going to work with all your other sources. So don't ignore the RSPs, don't listen to them, over-listen to the media. Make sure you have a plan, it will work for you. Investment or taxable accounts. These ones are usually the challenge during your working years because they are taxable, so your investments throughout those years can create tax burdens for you or tax challenges for you, but on exit, so in retirement, they actually have the most diversification where you can use dividends and capital gains to reduce your overall tax brackets. Really important to use those. And also if you have a deferred shared plan through work, those come due in retirement, have to plan for those and how that's going to affect your overall income. Now real estate, this one's another one that can do its own video on. So there's rental income, great way to have retirement and cash flow, but do keep in mind it's taxed just like income. It's at your top marginal tax bracket. There are some deductions. If you plan right, you can really bring that down and minimize the impact, but it takes planning, so don't wait till retirement before doing that. Reverse mortgages, I highly don't recommend. They're very specific situations where they can come into play and be worthwhile. Definitely reach out to us for a consultation on that one before stepping into that. And of course, downsizing. A lot of people have built up a lot of equity in your home. You can turn that into income if you have the opportunity to downsize. Again, take some plan and make sure you do it right. Make sure you get the most of the after-tax income on those proceeds rather than kind of just throwing it into a big pool. So as you can see, there's a lot of different sources, but the real strategy is how you're going to blend the 5 together to make sure you have an efficient after-tax cash flow. It takes diversification. The tax man's always changing the rules, so the more sources you have, the better. So with that, subscribe to our future videos. Go to mikeonmoney.com to book a consultation. We're happy to look at your situation and how we can help you plan for the future. Thank you.